Welcome to Opales TV. Today I'm in Munich, a city I lived for 25 years. We are in the famous hotel Bayerischer Hof, actually in the historic Watteau Salon. I'm accompanied by Anant Jatia. Anant runs a commodity arbitrage strategy that exploits a very specific and unique information edge based on the commodity merchant business of his family. The strategy has a 6-year track record, compounding at annually 10% with a volatility of just 4% and thus a Sharpe of about 2.46. So before we look at the strategy, Anand, please tell us a bit about yourself, about your commodity merchant business and how the two actually work together.
I founded Greenland Investment Management in October of 2013. My background, I graduated from Wharton with a degree in finance and computer engineering. Post that, I started at AQR Capital in their global stock selection team. I was there from 2007 to 2009 and moved back to India then with two colleagues to co-found India's first onshore hedge fund called Forefront Capital Management. It was a quant firm but focused on Indian markets. We built that business for around 5 years, and then I sold it to Edelweiss Financial Services, which is a large financial institution in India. In 2013, I started Greenland, initially with family prop capital, and then in 2016, we started accepting outside capital. Our flagship strategy now runs commodity arbitrage and FX arbitrage strategies, and then more recently, we have a standalone strategy, which is only a commodity arbitrage strategy. Now let me walk you through exactly what we do in our arbitrage strategies. So taking our commodity arbitrage strategy, here what we're primarily looking to do is trade the same commodity with the same specifications across two different markets, such that there's a genuine physical arbitrage that is possible if a physical player can transport the material from one market to the other, if there's a pricing gap greater than their cost of transportation or their logistics cost. What we look to do is systematically value what that transportation cost is and where we think we have an information edge on, and then look to systematically trade any deviations from that transportation cost, effectively betting that over time, as physical players shift inventory from one market to the other, the spread will converge back to its fair value. The way we go about valuing the transportation cost is that we have a family business, which is a physical commodity merchant business. It's a 40-year-old business. Because of that business, we have direct contracts with shipping companies, truckers, warehouses, insurance providers. And what we can get from there is this highly proprietary data on the daily cost of shifting a commodity from point A to point B. So we use that proprietary logistics cost that differs materially from publicly available data and use that to define our fair value. And then when we look to execute our spreads systematically, we execute via an HFT infrastructure that we've built out. It's a low latency infrastructure where we have co-located servers in 10 different venues globally, such that we can be assured of the lowest latency execution when we go to execute our spreads. We trade 15 different commodity markets globally. This spans across the US, Europe, Asia, including even the Chinese domestic commodity exchanges. All in all, we're trading 16 different commodity relationships, where 60% of our portfolio is in industrial metals, another 20% is in precious metals, and then the balance is split across energy and soft commodities.
I would say that within the universe of commodity trading strategies, your arbitrage strategies is pretty unique. Please explain us more, how unique is it really, and what are some of the benefits that you can offer investors?
So most commodity managers that you find are of two types. They're one, either fundamentally driven players, or they are trading more relative value, classic sort of statistical arbitrage strategies on that side. However, the way we differentiate ourselves is we limit our strategies to trading relationships amongst commodities, where there's a strong economic rationale for the spreads that we trade to converge back to their fair value. It's not only driven by historical correlations, but there is an economic rationale for why our spreads should be priced the way they are. And then the value that we are offering our investors is a differentiated source of alpha that's uncorrelated not only to most sources of beta out there, but uncorrelated to most other hedge fund managers as well. So let me tell you about the new strategy that we recently launched in 2019. So in our first strategy, we were trading both FX arbitrage as well as commodity arbitrage strategies. The FX strategy was actually capacity constrained, and we couldn't run more capital in that strategy. So now what we've done is we've taken the higher capacity commodity only strategy and are offering it as a standalone strategy, which is running at a higher volatility. So in the first strategy, we were targeting 4% volatility. Now in the second strategy, it's a 10% vol product that we have. And the idea is to be able to hopefully generate a higher return with that target volatility. With the second strategy, because it's a carve out from our first strategy, it also has a 6-year live track record of actually traded capital, even though it's a pro forma track record that we have out there. So we're taking our existing successes that we have and looking to kind of scale up the second strategy now, which has a lot more capacity available.
Tell us also more about the research process. How do you actually go about identifying and analyzing these arbitrage opportunities?
So the way we identify our arbitrage opportunities is first by defining what our universe is. Our universe over here is all liquid commodities that trade on any exchange globally that we can get access to. We then start by looking for relationships amongst those commodities that fit within our strategy buckets, which are the geographic arbitrage, substitution arbitrage, or cost of production arbitrage opportunities that we look to trade. Once we've identified a potential relationship, we first start by looking at getting the cost of transportation data historically that can define what the fair value would be between those commodities through time. Then, to construct the deviation from the fair values, we collect 15 years of tick-by-tick time-sync data across different exchanges to build out an exact bid and ask executable spread on an intraday basis on which we can then run our simulations. So what we can get is actual executable spreads, knowing what the bid quantity, ask quantities are. So our simulations can be as realistic as possible and can match with what we get in production. On our simulation process, we use a 2-parameter model to define how we size our risk in a given spread, and we run a surface of simulations to identify an appropriate set of parameters to pick from the set of simulations. What we're looking for is a couple things. One, we want stability across the parameters. So as you perturb the parameters, you still want your alpha to exist, not disappear because of small changes in parameters. And then at the same time, you're looking at some key statistics. Things like what the return per unit of turnover is, what the distribution of your drawdowns are, besides the classic performance statistics that you would be considering. What we then do is run these simulations on an out-of-sample set of data to then check how our in-sample simulations compare against our out-of-sample simulations. If there's consistency across the board, we can then look at taking the strategy into production. When we're looking at implementing the strategy, since we build out an high-frequency trading infrastructure, we look at whether we already have access in a low-latency environment to the exchanges that this new strategy would be traded on. If not, we look at co-locating our own server at the new exchange, connecting it to the rest of our network, and then deploying a low-latency algorithm right at the exchange itself to be able to then run the strategy on a real-time basis, analyzing every tick of data that comes in. Then on that basis, automatically and completely systematically executing the strategy whenever the markets are open.
So Anand, you mentioned the three strategy buckets that you follow in the strategy. I would be curious to hear for each one of those an actual trading example. That means an actual arbitrage setup that you have traded or that you would typically trade.
So we trade three different strategy buckets within the overall strategy. The first being geographic arbitrage. An example on this side would be trading copper on the London Metal Exchange versus copper traded on the COMEX in the US. Now, on both sides, the copper that we're trading is the exact same grade of copper. So it's grade 1 electrolyte copper. So what that means is that you can actually lift copper from one of these exchange warehouses and deliver it to the other exchange warehouse, creating an actual physical arbitrage that underlies the relationship between these two exchanges. So what we're looking to do is value what does it cost to shift material from one warehouse to the other. And anytime we see pricing gaps greater than that transportation cost, we're effectively betting that it will converge back to that transportation cost over time as physical players adjust for the inventory imbalance between the two markets. So that would be our geographic arbitrage book. The second sub-strategy that we're trading is substitution arbitrage. Here what we're doing is we're allowing for a slightly looser relationship amongst the commodities, where the specs don't have to be exactly the same. However, we want to ensure that the end use case of the commodities is the same, and then processing infrastructure for the commodities is also the same. A good example on this side would be trading milling wheat in Europe versus SRW wheat in Chicago. Now, because the grades of wheat are slightly different, one has a higher protein content. Because of that, it does not fit our definition of geographic arbitrage. However, since both these grades of wheat are still used in food consumption and it's processed through the same infrastructure, what it means is that if the price of one grade of wheat extends beyond a certain level relative to the other grade of wheat, the market can genuinely substitute one for the other, and then that process is going to cause the pricing gap between them to revert back to a fair value. So again, here there is an economic rationale as to why the spreads should revert to their fair value. So an important distinction on this side is what we don't do. So for example, we're not looking at trading things like WTI versus Brent. We don't think of these two commodities as substitutes for one another, because the type of refineries that you need to actually refine the different grades of crude are fairly different from each other. And then the type of byproducts and the percentages that you get from the refining process are also fairly different from each other. So the market can't just overnight substitute Brent for WTI or vice versa. So we don't think of that as a substitute trade. Now, the third strategy bucket that we have is cost of production. Here we're looking at trading input commodities against output commodities. An example of this side would be something like the crush spread on soybean. So if you take soybean and you crush it, what you get is 73% soybean meal and 18% soybean oil. Now, the combination of the two outputs, soybean meal and oil, relative to the price of soybean, the input, is fundamentally bounded. The two outputs can't be cheaper than the price of the input, because no one's going to crush soybean, because the processor is going to be making a loss. And neither can the two outputs be priced infinitely higher than the price of the input, because what that means is that more crushers will enter into the market to take advantage of the excess margins that are available in the business. And that process, again, is going to cause the spreads to converge back to their fair value. So the common theme across the three buckets that we trade is that there is a strong economic rationale for convergence back to the fair value. And that's our fundamental thesis and philosophy in the strategies that we're looking to trade over here.
So please tell us also about your average holding periods, how much leverage is in the strategy, and these things.
So our average holding period is around 15 days on the spreads that we trade. Now that 15 days comes with a fair bit of variance. So it could be as little as 1 day and as much as a few months as well. We don't look to target a specific holding period. So as long as the signal holds true and there is an arbitrage available, we'll continue holding on to a position. What we find is that the typical cycle time is around 15 days on the spreads that we are trading. Again, on the leverage side, we don't explicitly target leverage since we target volatility instead, and the leverage falls out of it. However, our average leverage that we run at is 6x gross leverage. So that's around 300 long and 300 short. That's for our 10% target volatility strategy. Now, we also have a 2x version of the strategy that targets 20% volatility. There, as you'd expect, the leverage is double at 12x.
So let's go a bit deeper. Tell us more about your risk management, portfolio management, position sizing, etc.
So the way we look to construct our portfolio in our second strategy is that we start with a 10% target volatility. We then look to allocate that volatility along the three sub-strategies that we run, which is geographic arbitrage, substitution arbitrage, and cost of production arbitrage, with the geographic arbitrage book getting an 80% risk allocation and the other two strategies getting 10% risk each. Then within the geographic arb side, we trade 11 different relationships over there, where we allocate the risk down such that no single strategy has less than a 5% risk allocation and no strategy has more than a 20% risk allocation within its overall bucket. Now, once a spread has been assigned its risk allocation, it runs fairly independently of the other spreads in the portfolio. The way we size our positions in a given spread is that we define the fair value, as we discussed, based on the cost of transportation, and then the deviations that we trade over there is we're trading the deviations in the form of standard deviations from the fair value. The idea being is that as the spread deviates further away from the fair value, we're going to increase our position sizing as we go along. So generally up to a 3 standard deviation move is where we're sizing into our positions, and we'll have our max position once the spread is at 3 standard deviations out. We take off our risk gradually as well. So as the spread starts converging back to fair value, we take that risk off gradually. So we're trading along the margin without having to require a spread to converge back all the way to its fair value for us to have taken a position off. Now, at the same time, we do have a risk management control in place as well. So in the event that a spread deviates further away from its historically modeled levels, what we define as a 3 standard deviation move, we start taking risk off in a gradual but increasing approach. So once it breaches 3 standard deviations, we start cutting risk down gradually, such that by 5 standard deviations, we're 100% out of the spread. So we think that this is an important metric to help us control tail risk on the portfolio. So in the event that there is some structural change that has taken place in the spread that we've not been able to account for, we have a way of limiting our losses on any one given position. So when we construct the entire portfolio together, we don't look at dynamically allocating risk from one spread to the other. So what we don't want to be doing is timing our spreads. So once a risk has been allocated to a spread, we let it run independent of the other spreads, whether there's an attractive opportunity in that spread at that moment or not. So let me also tell you about the primary risk a strategy like this faces. So we think our primary risk is geopolitical risk. So any event that can cause a meaningful disruption to the demand or supply of a given commodity, or cause jumps in the cost of transportation, either due to a tariff being imposed or taken away, or a duty change taking place, or a VAT rate being applied or taken away, or just changes in transportation cost. All of these sort of events can have an impact on the portfolio where it can substantially change the fair value in a short period of time due to an exogenous event taking place in the markets. Now, the way we look to sort of control for this risk is by diversification. So the idea is that the more spreads you trade, the less correlated that they are, and the average cross correlation that we face in our portfolio on 16 different relationships that we trade in total is around 10% cross correlation. So what that does is that even if one particular spread gets impacted due to an exogenous event, hopefully the rest of the portfolio, being uncorrelated, is going to lead to a dampening of potential losses that might occur from the event that might impact the portfolio.
So Anand, you also mentioned that you're using HFT setup, HFT technologies, or high frequency trading technology to execute your trades. I wonder, what's the edge that you obtain from that? Why have you included these aspects of HFT?
So that's a great question. We actually went about building our HFT infrastructure for our FX arbitrage strategy that's part of our first overall strategy that we have. Now, that strategy being a market-making strategy is something that absolutely requires HFT technology for it to succeed. For the commodity arbitrage business, given that it's a 15-day average holding period, it's not absolutely necessary to have this technology. But given that we already have this infrastructure in place, we can leverage the same infrastructure to execute these same spreads over the same infrastructure. So what that does is that in some of the spreads that we trade, the margins that you're looking to capture are fairly small. It's between 5 basis points to 20 basis points is, say, the deviations that you look to capture on precious metals, for example. Over there, if you have an HFT system in place, which can save you, 1 to 2 bips on your execution, you can get a much higher percentage of the P&L is what you can capture. And what it does is that it improves your transfer coefficient of your portfolio. So sometimes these spreads show up for really small amounts of time, maybe a few seconds or a few minutes, and your ability to then execute your view, your entire portfolio at that same spread without getting market impact and slippage becomes fairly critical in terms of getting a high transfer coefficient on your portfolio. Now, with a 15-day average holding period and a 6x gross leverage, it still translates to around 144x turnover in a year. So even 1 bip of saving on that leads to a 1.44% performance contribution, which is a very meaningful contribution to the portfolio. So that just gives us an outsized edge when we go to execute these strategies.
So I just have 2 questions left. Number one is, how sustainable do you think your strategy is? So what's the outlook? Or do you think it will be arbitraged away anytime soon? And talking about arbitraging away, I wonder, would any of the other large commodity players go into exactly what you are doing and basically squeezing you out of the market?
So we think of these arbitrage opportunities as persistent arbitrage opportunities because they're driven by genuine demand-supply imbalances of a commodity across 2 different geographies. Now, demand-supply shocks or demand-supply imbalances will always persist through time as the market can't perfectly predict what the forward demand is going to look like or the supply is going to look like. So as such, these ARBs will always sort of persist. Even if you look at very easy to access ARBs, like the copper example that we spoke about, that again still exists even today with good opportunity to make money on. Now, where we think these large commodity houses fit into this overall equation, the Glencores, Trafiguras of the world, we don't actually think of them as competition, but we think of them necessary in the marketplace because they are the physical players that are actually physically shifting the commodity from one market to the other, and then that process is what causes these spreads to converge back to their fair value. So they are the ones bringing the market into equilibrium by doing the physical movement of goods and collapsing these spreads. They always prefer to do these trades through the physicals rather than the financials because it's more profitable and you can guarantee your profits by doing it in the physical market, where in the financial market you're left with certain amounts of risk that you're not able to cover. So we don't think of them as competition in this space, but we think of them as necessary for these spreads to converge back. Now, we think of this as something that is going to be persistent through time, and it's an inefficiency that we are well geared to exploit thanks to our connects in the physical commodity trading business and our systematic approach to both research and execution. and it's a value that we think that we can deliver over a long term to our investors, giving them an uncorrelated source of alpha that's distinct from what's available in the marketplace of commodity managers.